Tim, what's going on?
It just doesn't quite feel right, does it, Mitch? Saying Market Structure Tuesday.
No,
Just
it's
Nah,
weird.
something isn't quite right.
Something's
Good to
wrong,
see you
Tim.
guys.
Where are you today? This is a different viewpoint. We got a
I-
new viewpoint in one of Tim's dozen houses here because he's in a different one here now again.
Well, I'm actually up in Steamboat, and now it's autumn, so my attire is reflecting that. I mean, it feels like autumn up here in the mountains. We're starting to see some color in the trees. It's 40 degrees here this morning, but I'm in Steamboat. This is the dining room view behind me. There's the photo over my right shoulder. That's Fish Creek Falls. One of our good friends is an artist up here. Shot that from the creek. But yeah, that's where I am in the mountains.
Beautiful.
Hey, can't blame you, Tim. I was up by Cooper Mountain this weekend, so I enjoyed it. I had a great time. I know the Steamboat's even better, but I made it to Cooper at least. Super excited to hear what you got to talk to us. This is the big talk right now. I mean, if we're really going to get into it, it's all about payment of order flow right now, right? And what's going to happen with the SEC. I'm going to let you run with Dennis because I know that you guys are way more experts on this than I am, but I would love to hear your opinion on it.
And well, thank you. And Dennis is one of the great market structure experts in the markets, and so this is a long running discussion, and it matters to you traders. This is it goes back to one of the principal reasons that I'm on, and that is that you want to beat the market by understanding it. And you'd say, well, I don't care about all this stuff. Well, you should. It's very. You talk about sports betting. You got to know the rules of football and baseball and basketball if you're going to be a successful bettor. You got to know what things will drive outcomes. Well, the same is true in the equity market. You want to understand, well, what does this have to do with what I'm doing? Well, it has a very big. It plays a very big role. If you trade for free, it's because of payment for order flow.
Yeah.
The reason that there is zero commission trading today is because retail firms sell their order flow to other firms who execute those trades. And so the reason we're talking about this is that the new head of the SEC, Gary Gensler, he's been around the markets a very long time. Dennis, you might know him. I don't know him.
I've never met Gary, but yeah. It's
Yeah.
interesting because me and you, Tim, have been talking about this for like a decade. Like I've known Tim for a long time, and we've had this conversation and on payment for order flow, and we've been talking this stuff for a long time. So I think we should just catch up the viewers. Let's you were going there. Let's catch up the viewers on what exactly payment for order flow is and what Gary Gensler is saying.
Yes, so there's concern that trading has become sort of gamified, thanks to Robinhood with 20 million accounts. By the way, there are 100 million of you, retail traders. If you add up all the accounts at the Schwab Ameritrade,
The hood.
100 million people. Schwab Ameritrade, Fidelity, have to add Fidelity in, E-Trade, Morgan Stanley. Robinhood, and then I'm missing somebody, but then there's smatterings of others, but no, that's it right there, because Schwab and Ameritrade have combined. So you take those big five and it's 100 million accounts. So the key to understanding payment for order flow is that when you put in a limit order in particular, there can be exceptions to this, but generally if you're putting in a limit order to buy or sell stocks, that order is sold to somebody like Citadel or Virtu or UBS. Jane Street's getting into this business. And there are some smatterings of others that do this. And so their job is to execute that trade for you. And it's because that selling that trade produces cash. And it's for Robinhood, it's well over $1 billion a year that they're generating from selling these orders.
It's the majority of their revenue.
It's the great bulk of their revenue. That's what they're doing. They're going to make revenue principally from selling the trade and lending you money. And this really is the bulk of how retail trading works. It's what Schwab and Ameritrade do too, and Fidelity does this. This is the way that the world works. And why is it the case? Well, it's because the market is very complicated. The rules require stocks to trade between the best bid to buy and offer to sell. And then brokers are required to meet what's called best execution standards. So that it's a fancy way to say they have to trade within the best bid and offer a certain percentage of the time. If they don't, they're fined by the SEC. And so what has happened is we've seen order flow concentrate into a handful of firms. About 30 firms execute almost 100% of trades now. It's about 94, 95%. And so that's how the market works. It enables retail folks to have very inexpensive trades, and it enables firms like Robinhood to generate a lot of revenue from selling your trade. So they want you to do limit orders. Now, what's the good and bad out of this? Well, clearly the good is you get free trading. Yeah. What's the bad? Well, to me, that's a much larger question. Am I for it or against it? I am not a fan of markets that are built around arbitraging small spreads. I don't think that is long-term healthy for markets. We want markets that are effective places for capital to form, for enterprising firms to find risk-taking capital, and the two can meet each other and create wealth for the society. So I'm not a fan of this, but I don't think that you can pull one piece of this puzzle out without damaging the way that the market works. And that's what we have to, that is my position. And we wrote about this last week. So that's what you should know. This is how meme stocks happen. An immense number of orders to buy that are limits at various prices enter the pipeline, and now Citadel will see that and say, okay, well, let's look at what direction the price could go and how far up are we going to fill these. And they can manufacture stock. I've talked about that before, an exemption from Reg SHO Rule 203(b)(2 jargon stuff, but that's how the market works. So I would be very concerned if we just take one piece out of that puzzle, because the whole market would falter. We depend for almost 54% of prices from this kind of activity, by the way.
And the majority of markets liquidity, that's the one thing. And obviously I've been an advocate against payment for order flow for the better part of a decade, because I believe, and not so much on the payment for order flow aspect of it, but the other aspect of it, I'm a fan of on exchange trading. Like, I think the issue I have is that I feel like our equity markets continue to drift to the dark. And what does that mean? It's like, you think about the bond market, they've been trying to shine a light and transparency into the bond market for decades. And here we have the equity markets, which are just slowly drifting to the dark. And, the dark being, it's not as transparent. I mean, when you see an executed trade coming from an off-exchange market maker, it just hits the FINRA tape. It's not that transparent. There's no pre-trade transparency. It's just post-trade transparency, where you see the trade consummate and trade, and then it hits the consolidated tape. But what you have is, when you have price formation happening on the exchanges, you have pre-trade transparency. And the one aspect that people have to understand is that price discovery happens on the exchange. The prices that you're getting from the off-exchange market makers are derived from the prices that are on the exchange, the bids and the offers that are in the books and the lit. So they'll say, an offer's coming in to buy 1,000 shares of the market. They'll look where that national best offer is, and they have to execute it, within reason at that price. But if you continue to take all of these orders and slowly drift them away from the public transparency of the exchanges, what you have is less orders, and markets could tend to eventually start to widen, meaning you might not get as good of a price as you could if some of those orders were originally brought onto the exchange. So I know we've got Dave Lauer on the show talking that. What are your thoughts there, Tim?
Well, I agree. And I see it in my own trading. I wrote last week that out of the last 10 trades that I executed, 5 of them not only were all but one in dark pools, principally my own broker's dark pool, but half of them were at tenths of pennies. Literally a fraction of a penny. And you'd say, well, you get a better price. Well, yes. But then the pursuit of tenths of pennies becomes a major part, an end unto itself in the marketplace. So here, folks like Mitch, we're all trying to do work to figure out where there is an opportunity from good business decisions, well-run businesses, to create opportunity for returns on our investment. And then behind the scenes, half the volume is machines pursuing 1/10 of a penny. Well, I don't think that is supportive to our overall objectives. That's what's going on. But again, you have to be aware of this. It gets back to me to why edge matters. Always have a little self-interest in here. It's the American way.
We all have a little self-interest. The world is capitalism is built on self-interest.
Right. Exactly. And it's supply and demand. You have to realize that there's a significant part of demand that is very fleeting. So if you think that the market is being driven by, well, people believe that Microsoft is going to be the best performer in tech and software, which it might, but the supply demand balance isn't correct. I don't care how much you think Microsoft wins, the price goes down. Now, fortunately, Microsoft is one of the $5.7 now almost $1 trillion companies, but that's the point. So knowing these things, it's vital to understand the market the way that it works. And that supply and demand can be measured, and it should factor into how you think about the market. You can't just think, oh, that's a great company, it's going to do better than other stocks. Not the case. I'll give you a great case in point. So Match and Brown & Brown both added to the S&P 500 on Friday after the market closed.
Yeah.
So then one of them goes up 14% and one of them goes up a handful of pennies. Well, why? I mean, both added to the same index. What's the difference? Supply and demand. I could even show you if you like.
Let's see this. If you can't show us, I would love to see this actually, because this is a question we get on the show all the time. Why a stock gets added to the S&P. Sometimes they go up, sometimes they go down. Why?
Right. And to me, it's very stark. So here's the dashboard at Edge. By the way, you can try this. Just put in your name and an email. Don't need a credit card. If you haven't tried it yet, a lot of you have, and I always get notes about people looking forward to Market Structure Monday. Today, Market Structure Tuesday. But this is the beginning point. So this is today's portfolio. Notice this. Demand side looks pretty good. Supply side looks pretty good. That's how we think about it. Is demand rising and supply stable or falling? Because that will contribute to better prices most of the time. When that reverses, look at building materials. Already we've hit peak demand and supply is beginning to increase. Well, if you're in building materials, time to get out. So let's go look at Match and Brown & Brown. I'm going to scroll down. So Brown & Brown is right on the top there, and it's sitting right at the fulcrum of supply and demand. Right away, that tells us something. And it stopped falling right at 5. It's 51% short. 51% of the trading volume, more than half of it, is coming from borrowed stock. And the key behavior is passive money. So you've got 17 billion in market cap. Okay, so then let's go down here and look at Match. It's 10 out of 10. It's slamming into the ceiling. It's 20% less short, less supply. Come over here and look at the behavior. Risk management. People are buying calls on this. That's what it's telling us. Look at the size of market cap. 40 billion versus 17 billion. Right? So it's 2.5 times larger. So there you go. If I look at the supply demand equation, now it's hitting the ceiling, but look at that. This is the way that I think about this. The supply side's on the bottom, so supply is declining back to trend, and demand is just slamming into the ceiling. That's the kind of condition where a catalyst, like being added to the S&P 500, can cause a stock to surge. There isn't enough stock. Now, if we look at BNB, BRO, what a great ticker, bro. And look at that. So here it already peaked. It's being led by passive money. Passive money already knew this, so they've already done their thing, and demand has returned to the fulcrum 5.5, and supply is rising. The likelihood that stock surges is much lower because there's balance between supply and demand. It takes imbalances, and Dennis, you're a big fan of looking at the order imbalance pre-open. It's the same idea. We're looking for supply-demand asymmetries. And this one has symmetry, Match did not. And you will know that. You can see it in the data.
So Tim, let's just sum up. You've got another minute with you here. Let's just sum up your thoughts for the week. We're coming out of holiday trade. I know dog days of August. I could feel it as a trader. August was just starting to pick up a little bit for a couple days, but it was a slower month. Typically September gets us more volatility as traders are coming back to their desks, back from their holidays. Right. What do you see coming here for the overall market in the next couple of weeks?
So one of the things we say at Edge is there are 5 easy steps to using Edge, and the 5th one, the umbrella concept is always manage overall risk. And we use data, the composite S&P 500 stocks. So we take all, the 500 stocks, go ahead, a little change. There have been some changes here. Some companies removed, some added. It happens effectively quarterly. So we want to know, what is the supply-demand fluctuation in that measure? This is how we think about what may be coming. And I like a 90 trading day view of this. So the dark part of the graph is the waxing and waning supply and demand in the S&P 500. Those 500 stocks, they're 85% of the market, so it's a nice gauge. Notice this, that they've traded the whole time effectively between 4 and 6. That's where the market is. A GARP, growth at a reasonable price market, will be around 5.5. Well, that's where the market's been. It got down to 4 here, nice opportunity to buy, and it really hasn't been there since. And look where it is now. It's bouncing against the red line. And you can see that every time the market bounces against the red line, bounces here, price goes down. Bounces here, price goes down. Bounces here, price goes down. Bounces here. This one was a little bit different because there was so much demand coming out of August expirations. We could see it. Money shifted back to risk taking into the big cap techs. So we did a little better, but here it came. It was just a little delayed. And where are we now? Bouncing against the top. So I would say that we're going to have some kind of pullback. I don't know that it will be significant. I can tell you that what has supported the market over the last month is passive investment. We had in the S&P 500, 15 of the trailing 20 days were net buying days, and they were absolutely dominated by exchange traded funds. So when that stops, we could have some trouble. So I won't be surprised if there's turbulence. No surprise to you either, Dennis. Just as you said, people come back and they look at macro factors, the conditions in the market, the economic drivers, all of that, and we can get some turbulence. I'm not saying it'll happen immediately, but maybe into options expirations in September.
All right. Thank you, Tim, for another week. I mean, like always, guys, if you haven't checked out marketstructure.com, definitely check it out. I myself have done it. I enjoy it because at the end of the day, you guys know how I try to stay with the industries and sectors, stay with the herd. So if you guys want to check that out, I definitely recommend it. You don't even need a credit card. Thank you, Tim, for coming on.
Good to see you.
Thanks, Tim.